What's going on, guys? This is Vlad, and today we're continuing the first presented fair value gap series, where I will reveal everything I've discovered so far about the first presented fair value gaps. It's something that I've been studying a lot in recent times, and I just wanted to share everything I found about the gaps and how price delivers around them. Uh, Please keep in mind this is not something that ICT actually taught in his lectures, or at least I never heard many of these things that he spoke about. So always question what I'm sharing with you, always backtest, and of course, for the most accurate representation of ICT concepts, you should always refer back to ICT himself. Okay, I'm just a diligent student who wants to learn, who listens to ICT, tries to study the things he shares with us, the things he's hinting at also, because these things about first presented fair value gap, he never went in depth about them. So I might be wrong on many of these things, and that's all right. Okay, the man himself, he promised to share a lot more on first presented gaps in his book, and I honestly can't wait for the book to be out. Okay, but anyway, let's get on with today's lesson. And before we do, I want you to listen to a very short extract from one of ICT's 2024 lectures. Okay, and then we'll continue.
And how many times it used it. Key takeaway. What is August 1st? First day of the week. What time did that gap get referenced? It happens every single month because the algorithm will go back to a specific date. What date would it use? First trading day, first day of week, Wednesday, previous Friday. That's not all of them, but I'm proving that there is an algorithm and it's going back to days specific. Why? Because it has to go back to a frame of reference. We're in a new month. Okay, what month are we in? August. Let's go back to the first day of August. Use the first pertinent PD array of August. Carry it through your chart. And you're going to see shit that you never saw before. It makes it so tradable where any opportunity you see where you can engage that one, and as long as it matches time of day when the market should deliver, it's just obvious. This is a real easy. That's one of those times when you ask me, how do you know which fair value gap to use? Well, that's one of them because it has to be anchored to a specific day that is meaningful. First day of month, first day of week. What's the first fair value gap that forms after 9:30 on a Monday? Draw that bitch out through the time over the course of your week and the month. Oh, this is too good. I'll give you too much shit. I'm giving too much away. What the hell? I'm gonna have to open up a mentorship. I'm never gonna be able to eat again. How am I gonna keep giving this shit away for free? How can I make my ends meet if I keep giving it away for free, right? Oh, anyway. I've had so much fun with y'all today.
Right. If you miss these things during the 2024 lecture series, well, that's the reason I'm telling you guys. Always take notes. These things sometimes go over our heads, and we forget about them. We don't study them, even though ICT told us to check them out, and we never do. And it happened to me before, honestly, and that's why I just wanted to play this little extract, so you can see it's there. It's there in the videos. He's pointing in a direction that's worth exploring, and actually that's everything I did. I just explored. I explored the things he told us to explore. So anyway, wanted to share more on these first gaps with you, and today specifically I want to talk about liquidity, and liquidity more specifically in the form of relative equal highs and relative equal lows, okay, in respect to the first presented fair value gaps. And before I start, just wanted to share with you, just wanted to tell you that if you didn't watch the previous video where I'm showing you the exact reversal points and swing points that these first gaps are showing us, you might want to check that out, because all these videos, all this series on the first presented gap, they'll build upon each other. So we're gonna try to build a model together, and it's gonna combine in itself all these things that I'm sharing with you in each of the videos. Okay, so if you didn't check the previous video, it's a fairly short one, so I'll leave a link in the description, and please go ahead and check that out before you continue with this one. But anyway, when we're talking about liquidity, so from ICT we know that when the algo is doing stop hunts, or it's rating certain pool of liquidity, what is he teaching us in 2024 mentorship to look for? Okay, before 9:30, for example, he's teaching us to look for relative equal highs or relative equal lows. Okay, and these are our primary targets. And more specifically, he's teaching us to look, when we're looking for relative equal highs, he's teaching us that this high on the right should be lower than the one on the left. What does that mean? That means that the algorithm created a, how to call it, a level, or you want to call it a zone in a retail world, where it's basically creating a false sense of security in retail traders, making them think that this is a level of resistance, right? And then eventually the algo will go on and purge that liquidity, right? So when we're looking for relative equal highs, you want the high on the right to be a lower high. Okay, this makes this specific pool of liquidity high probability. Okay, and vice versa. When you look for relative equal lows, you want the low on the right to be a higher low. Okay, and then in the retail world, that will be a level of support, right? Is giving them a sense of security that this level will hold price, and then eventually the algo will run that liquidity, the market will run that liquidity before continuing in the predetermined direction. Okay, it may be a continuation down or a reversal up, doesn't matter. But these pools of liquidity, these are the one of the highest probability pool of liquidities that there will be a run on. Okay, so this is how you identify relative equal highs and relative equal lows. Okay, if this low here is lower than that one, that decreases the probability that we're gonna rate that low. Okay, because essentially when you have a lower low, that is a rate by itself. Okay, that is a run on stops by itself here. So that is why you want this to be a failure swing like this, and then at a later time we'll purge that liquidity. Okay, so that's why this is what you want to look for when you're looking for relative equal highs and relative equal lows. So now that we know that, we can start looking at what we looked at last time, plotting all these first presented fair value gaps, and try to look for exactly this concept, relative equal highs and relative equal lows. And we're going to notice something very, very interesting. So, as you know, I've already plotted all the first presented fair value gaps of April that we so far formed. And that is 4 weeks of gaps. And I'm going to go through the month now and show you specific things that formed around these gaps, and I'll show you the relative equal highs and relative equal lows, and we're gonna look together and how they formed and where they formed, okay, with respect to these gaps. So this is April 4. This is March 31st. It's a Monday. So this specific gap here. And whenever the new month starts, so April 1st is the next day here, obviously. Whenever the new month starts, the monthly candle, it will, just like every other candle, doesn't matter which time frame, it will refer back to the range of the previous candle, right? Unless there is a liquidity void or like a real gap, okay. But in the general case, it will refer back to the previous range. So in the previous video, I didn't show these two gaps, but I plotted them now, so you can see that this run up in the beginning of April was not random at all. These are the gaps from March 27th and the gap from March 28th. So that's Thursday and Friday of the previous week, okay? And you can see how, first of all, here on April 1st, right after we formed this first presented fair value gap, price went down, and I showed you this in the previous video, just to make my FIP a little bit more visible. I showed you in the last video, if you plot the FIP between the first presented fair value gap of April 1st and the one from March 31st, right at the midpoint is where the Judas swing for that day ended, and then we moved up on the day, okay? See that? Here and here. If you plot this same FIP range from this fair value gap of Tuesday, April 1st, all the way up to Friday, March 28th, so to the low of March. So from the high of April 1st to the low of March 28th, you'll see how price reacts at this level. Look, before it starts dropping down again. Then on Tuesday, that's it's not Tuesday, it's Wednesday, April 2nd. We start running up. Look at this. Let me remove these FIPs. Look at where this initial price run, this initial leg stops. Look, the bodies. That's a 15-minute chart. The fair value gaps are 1-minute gaps, okay? So look at where price stops the initial run and then goes down, it retraces. And where it's retracing to, sorry, I removed the FIP, where it's retracing to. So it's retracing to the midpoint, okay? And then we have the second leg. And this second leg goes all the way to the Thursday, March 27th gap, and then we have the drop. I believe that drop was right around when Trump announced the tariffs, so it was right after market. You see at 4:15 or so. But there is something very interesting. Not only we stop right at the gap, these previous 2 week Thursday and Friday gaps. Look at what happens around these gaps. Guys, look at that. These highs are very, very smooth, right? You agree with me? This is a very smooth area. Let me remove that so it's visible. See? These are relative equal highs. Exactly what we discussed in the beginning of the video. These are relative equal highs. Now I'll bring back the first presented fair value gap of that day, Thursday, March 27th. You can check it on your chart. If you don't believe it, these relative equal highs formed right there at that gap. Okay. We also had relative equal highs here. Okay, right below that. But we rated those. Why it didn't stop here? Because those relative equal highs that formed at the gap, the first presented fair value gap of that day, they are the high probability candidates to be purged, okay? The liquidity above them to be purged, okay? So when you're looking at first presented fair value gaps, of course, this, guys, this is a valid, these are valid relative equal highs. They are a good target to have. But when you have the gap in confluence with these two, that makes the probability very, very high in your favor that these two, the lower ones, are not the final objective. It's those. Those are the final objectives. Okay, the ones that formed at the first presented fair value gap. Okay, right there. You also have here a CB that also makes it a very high probability. Okay. Anyway, then the market drops. Okay, it's a repeating phenomenon that you're gonna see now when we go through the month of April, how these relative equal highs formed at these very, very, very specific levels. Okay, they formed around the first presented fair value gaps. Not always, guys, not always, but very, very often. And whenever it happens, the probabilities are high in your favor. Okay. All right. So when we start going forward, you'll see how here we formed relative equal highs, which we after that rated. Sorry. So this high and this high, they're relatively equal, and they match the criteria that there is a failure swing here, like the high on the right is lower. So these two, they match our criteria. Okay, price goes down. That's these are formed in Asia and beginning of London. Price goes down, retraces. There is a new day opening gap here. So we're basically working that. And then, right, what is it, 315? So and around 330, we start running up, okay, to raid these relative equal highs. And then the market drops, okay. here is when Thursday, April 1st starts. And if you remember from the last video, the Judas swing, see here, it stopped to the tick in the midpoint between these two first presented fair value gaps. So Monday, March 31st and 3rd of April, Thursday. Okay, right there. You can check it on. We can check it on the 1 minute chart if you want, just to see how insanely accurate this is. Okay, and let me actually do that for you, so you can see it, how it looks on the 1 minute. There it is. I'll calibrate that a little bit. Like this. Yeah, it stops one tick below it. Okay. You have your market structure shift here. There's so many models here, guys. It's insane. You just pick the model you trade, and it delivers. You have a market structure shift here, okay, with a gap. After that, you have a gap here. You can also use, so that's the 2022 model. You can use an inversion gap model that I taught in a previous video. I'll leave that also in the description for you. But basically, this is your inversion. We sweep that high, then we displace down. We trade back to the inversion gap, fail to close above it, and then displace again. So this second displacement can be your entry. Okay. And let me actually not extend this. So this gap is your entry. Okay, this is your entry with stop loss above here, and then the rest is history. The rest is a 250 point move. Okay. Okay, I'll remove this so they're not confusing for you. And I'll go back to the 15-minute chart, and I'll remove the bar replay. All right. Anyway, the market dropped massively that day, and it kept dropping the next day. April 4th. By the way, I am missing a gap here. Why am I missing a gap here? Okay, let me plot that on the chart real quick. Where's my gap? First presented gap will be here. All right, and that will be Friday's gap. That is Friday, April 4th. Okay. Fifteen-minute chart. And there it is. Okay. We have the Friday gap. Look what forms right here, right above the Friday gap. It's yeah, you guessed it. It's relative equal highs. CB. that's important. It's for a confluence. And then you have the relative equal highs here. These may not be so obvious for you on the 15-minute chart. And you can as well go on the 5-minute. Where is it? You can go on the 5-minute and they'll be a lot more obvious. Look at that. Look where they form. Okay. These two, this one, right around that. It's a cluster of highs in relative equal proximity, relative equal close proximity. Okay. Whatever I said there. And yeah, they're high candidates to be rated. Okay. And we do that the next Monday. Okay. Right at the open, it just rips up to those relative equal highs. Okay. Anyway, back to the 15-minute chart. Back to the 15-minute chart. We have here relative equal lows that formed. We didn't go after them, obviously. That day price just ripped through those relative equal highs here and then continued for the rest of the day. It was consolidating and it went up overnight during Asia and London, all the way back up to these relative equal highs. And then it switched gears. Okay, this is Tuesday, April 8th, first presented gap. We went up, rolled over, then used this gap as an inversion here at 11:30 to start delivering down to the previous gap of Monday 7th. Okay, so from Tuesday, we went back from Tuesday's first gap, we went back to Monday's first gap. Okay, that's a repeating phenomenon. You see that very, very often. On Tuesday or on Wednesday, price will go back in the direction of Monday's first presented fair value gap. If you don't believe me, check it on your charts. It happens almost every week. It may not reach the gap completely, but it may go to the midpoint between Tuesday's and Monday's gap. It may go to the midpoint before extending up, or it may go all the way up to the Monday gap, okay, and then continue up. Or it may go to the Monday gap, use it as an inversion, and send price lower. Okay, these are the three scenarios that can happen, and of course you have to watch what happens around the Monday gap and in the midpoint between the two, so you can figure it out what the market is trying to do. That specific move, it doesn't have to happen on Tuesday. Sometimes it happens on Wednesday. So, okay. We know from ICT that usually the weekly high or low is formed on a Tuesday, okay, or on a Wednesday. I'm not going to go into probabilities here, but if you listen to ICT long enough, you will know that. If you go through the core content series, you will discover that for yourself. Actually, I think I might have some statistics in probabilities about that somewhere. I'll try to find it for the next video and show to you. The probabilities are, I think, around 80% that Tuesday will be the low of the week, if I'm not mistaken. But I will check that out and I'll share in the next video. Okay. And then price starts going up. Now, obviously, that Wednesday price just ripped above like it was like 2,000 points. Yeah, that was when Trump announced halting on tariffs, okay, for 90 days. But if you paid attention, you'll see what happened earlier in the week. We formed relative equal highs. Between Monday and Tuesday, that's exactly what we did. Where did we form them? Yeah, around this first presented fair value gap of Friday. Okay, right above it. So that gives you a directional bias. Okay, it gives you a directional bias. So price goes up to purge those. And then here it formed again relative equal highs. That is a first presented fair value gap of Wednesday, April 2nd. Okay, then price roll over. Let us mark these so we don't forget them. We didn't refer back to them immediately, but let's mark them out. There was a relative equal highs here at this gap also, Monday, March 31st, that formed on the way down. Okay, what else formed here? Those right below Thursday, April the 3rd. Okay, price eventually went down, and I showed you this last time. Where it stopped, it's the midpoint between this Wednesday, April 9th, first presented fair value gap, and Thursday, April 10th, first presented fair value gap. Okay, so it's the current day gap, the current day. Okay, that's Thursday. This here is Thursday's price action. From that, you want to look what's happening below. What is happening? We have last Friday, but we also have yesterday, Wednesday. Did you hear what ICT said in that little extract that I shared with you in the beginning? What did he say? Monday, Wednesday, last Friday. These are the things he told you to focus on. I mean, there are other gaps. There is Tuesday, there is Thursday. But these are the ones that he put significance on. The most significance, okay? Here's your Wednesday, yesterday's gap. Look, the bodies. Look where they stop. Because I know some of you say, how do you know which ones you're picking? This is it, man. He said specifically which ones to pick. So on that Thursday, you want to refer back to, is it this Tuesday gap? No, it's the Wednesday gap. That's what he told you, okay? You can check out what's happening on Friday, previous week, and look at that. Once we started going up, Friday then acted as a support. Okay, but we had to go down to the midpoint between today's gap and Wednesday's gap first. Okay, so now we have all these relative equal highs above that we already discussed. There is also these gaps here that formed right below today's first presented fair value gap, so they were prime candidates overnight to be run, and that's exactly what we did. Now guys, you're not going to have all of these relative equal, you're not going to be able to catch all of these relative equal highs, relative equal lows, every single move, but they give you directional bias. So here on the beginning of that day, where is the relative equal highs? You look at the Thursday's gap, so yesterday's gap, and you find them. They're there. Look. Look. This and this. Right above it. The wicks. The bodies, they stay in the Thursday first presented fair value gap. The wicks go above it and they form relative equal highs, which gives you directional bias for that day. It's bullish. Okay. Here we already made it jagged on the bottom. We already purged here London low, okay, which was also relative equal highs. So this 9 o'clock low and this 4:30 low, they were relative equal. We purged that here. That was the Judas swing, okay, and then price started going up. So you can start hunting bullish setups here in this leg. And I'll show you how to hunt those setups. We'll get there, but not in today's video. It's going to be in a future one. Now, we have Friday. Draw your fib between this Friday and last Friday. The midpoint, this is your point of interest, if you want. This is where you expect the reversals to happen, okay? And we can look at that. We can look at that in the 1 minute. Let's see what's happening. Or on the 5. So we sweep that low. Let me calibrate that a little bit. Okay. We sweep these relative equal lows here. Back down. We have a market structure shift around here. There is a gap that you can use here for entry. Look, 130. That's your PM macro. You have the relative equal highs above already. So that's your perfect setup. The morning was not good. It was choppy. There was no good inefficiencies that were left. But this one here, the PM, this was very obvious. Very obvious. So this is what you want to look at, to chase and trade, okay? That's on the 5 minute. If you go on the 1 minute, you see that there was a market structure shift here. Price then went down. It was a messy delivery, guys. It wasn't good in the morning, okay? You couldn't use the first presented fair value gap for a setup. But after this market structure shift occurred, here is what? 11:25, 11:30, launch macro. There was a gap here that we refer back to, see? And then price started going up. But on the way up, it didn't really leave a lot of inefficiencies. As I said, the 130, that was the cleanest setup. Look at this. Original consolidation, market maker sell model, back to the original consolidation. We don't need to go below it. And then price starts going with speed to those relative equal highs, which formed right above this first presented fair value gap. So you see, guys, you see how these gaps, they are like a roadmap on how the price will deliver, where it will go next. It's unbelievable. Once you start exploring this, it's unbelievable what these gaps can reveal for you. Let me remove some of these fibs. There's too many. And I know you can say, yeah, that's a lot of gaps. It's kind of messy. You don't have to keep all of them on your chart, but if you do what ICT told you to do, that's enough. That's enough. Keep last week's gaps. Keep the Monday, Wednesday, Friday gaps. So you can find those reversal points and trade off of them. Okay. Anyway, going back to this 15-minute chart, you can see that we formed more relative equal highs here that will later on be purged. And when you're looking at this, just pay attention where they formed. Okay. This is the midpoint between these two gaps, guys. It's the midpoint. Let me show you the FIP. Look where they're forming. Perfect candidates. Okay, then we go down. Here, relative equal highs formed around the Thursday, April 10th, first presented fair value gap. Relative equal highs here formed Wednesday, April 16th, first presented fair value gap. See how later on, when we have this run up, we go exactly after this. This here, right? See that? All the way up. See where they form. Relative equal highs, relative equal lows. It's around the gaps. It's in and around the gaps or the midpoints. So, I think that was a mouthful for today. I don't want to make these videos way too long because I don't want to overload you with information. You have to take this step by step. It takes a while until you start seeing all these things, until it starts not messing up with your ability to process it, because these charts, they can get very busy when you plot too many gaps or you start overthinking every move and every relative equal high or relative equal low, so I'll leave it at that here, and I'll let you study these things for yourself a little bit, and in the next video we'll talk more about them. We'll talk about fair value gaps and how they formed with respect to this first presented fair value gap. So inefficiencies, how inefficiencies form around these things. And so I hope you like this one, guys. If you are new around here, please hit the subscribe button and support the channel. Leave a like on the video and comment, of course, with let me know. Do you like it? Do you like this kind of content or not? Is it resonating with you? Do you have other things to share about these gaps? Maybe something that I never thought of. I'm open for a discussion. Okay. I'm not saying that this is 100% correct or it's the only right way to trade. Not at all. It's just I'm showing you things that I discovered, and I hope you will find value. Okay, and until I speak to you in the next video, I'm out.